Hi, I'm David Busch, the Co-Chief Investment Officer here at Trajan Wealth. Check out my interview on the Schwab Financial Network, where we discuss the most recent inflation trends, what the Fed's next moves might be, and how you can position your portfolio for success.
Let's take a look at the bigger picture now with Dave Busch, who's the Co-Chief Investment Officer at Trajan Wealth. What do you make of what we got from both inflation prints and what it now means for the Fed? I mean, does the hotter than expected inflation print that we got today from the producer prices change the narrative at all?
I believe it does. As you know, we talked about earlier on the show, CPI came in and basically in line with expectations. But today we saw hotter than expected PPI inflation. So what that means is that some of the producer prices have increased, which will ultimately lead to consumer prices increasing. My assumption is that it's primarily tariff related, and as a result, that will come through. But the key to remember is that with inflation expectations, we're seeing that bear steepener in the bond market today, with the back end of the curve coming up. Meanwhile, the front end seems to be relatively stable. So inflation is still persistent, is still sticky, and it means that the Fed will have a longer path for rate cuts.
Okay, so if the PPI precedes the CPI and perhaps what we got as far as the wholesale prices does start to show some pass-through maybe next month, is that going to be a huge surprise for the markets because of the fact that that print is coming up so close to when the Fed needs to make that September decision?
Yeah, it's interesting because, when you look at correlations between PPI and CPI, there is a strong correlation between the two, but it's very apparent in certain segments of PPI and CPI. So anything that's like food, energy, and so on, those prices will flow through to consumer prices relatively quickly. Some of the longer, inflationary pressures, in particular for manufacturers, will come through later in the year. So I would expect that inflation will be persistently above the Fed's target, at least for the remainder of this year.
Okay. What do you make of the reaction that we've seen so far? Because we sort of saw a bit of an everything rally on Tuesday off the back of the sticker prices. Then we saw a bit of a rotation day yesterday into perhaps some more sort of rate-sensitive areas of the market. But now it seems that the Russell 2K, which had been catching a bid, is underperforming, and we're seeing money flowing back into, your big cap tech names. So what's your read on, how traders, investors are reacting to these latest headlines?
It makes sense, for large cap tech, large cap growth, particularly those companies that are profitable, that they'll continue to get a bid. I mean, look, tech and AI is the future. So, that's why those companies are going to continue to get that bid. But I would also look at those cash flowing tech names, which will benefit the most if the Fed cuts rates on the front end of the curve. Meanwhile, long end rates stay relatively contained. I would also look at other sectors that may benefit from a steepening of the curve. So on one hand, there's consumer discretionary as an example. So lower borrowing rates plus, a better than expected labor market numbers today, with initial and continuing jobless claims coming in better than expected, may be a benefit for travel and leisure, especially for that high net worth cohort of people. I would also consider REITs, real estate investment trusts. And here's why. That is, rates come down, the valuation of the underlying property will improve. And as long as the property is cash flowing, or the real estate investment trust is cash flowing, that could be a nice benefit for some, especially those income-oriented investors. But I would caution that investors need to move up in quality in that sector. And then finally, bonds, this is a great opportunity to buy fixed income. We've been over a decade and a half of very low interest rates, and rates are higher. But what I would focus on is sort of the intermediate part of the curve, and I would balance that with an allocation towards Treasury inflation protected securities on the front end, which should help offset some price volatility for any fixed income investors.
Okay, so that's how to sort of approach a more sort of balanced and diversified portfolio. What are you watching next? You know, as far as the catalysts are concerned, what metrics are you paying attention to?
Yeah, the big one is coming up. I mean, we have retail sales, but also the Jackson Hole Symposium, which will be later this month. So all eyes and ears will be on any speakers, especially when Fed Chair Jerome Powell speaks, because everybody's going to be looking for an indication in terms of how they view both the labor market and inflation. And my assumption is, or my thought is that they're going to try to come out with a more balanced approach and more balanced language as they move forward in time, which means that they'll likely have a longer path for rate cuts.
Right. I mean, on that, no doubt some of the data and the information, certainly as far as the economic updates we've been getting, and obviously we're going to get more evidence of that tomorrow, to your point, with the retail sales, just makes that Jackson Hole gathering even that more significant and critical as far as the messaging is concerned. But, you know, while the September rate cut bets seem to be alive and well, as you know, Kevin Hinks and I had just been talking about. It's also not just been a case of when, but how much. I mean, you have Besant sort of suggesting that we could be going potentially 50 basis points. Then I think it was Mary Daly who sort of suggested maybe that's not the case. I mean, how are you looking at all these headlines and trying to sort of cut through the noise? I mean, what's your take on where you sort of sit on the rate debate right now?
Yeah, I feel, you know, I think the Fed is in a bit of a conundrum because on one hand, we still have pretty persistent and sticky inflation. But on the other hand, we're starting to see some cracks form, especially in the labor market with the recent revision, as well as if you look at the underlying data for consumer health, there's an increase in delinquencies and defaults across the consumer borrowing spectrum. So credit cards, auto loans, now student loans, and so on. So I think that the Fed is trying to balance both of those out because the labor markets are still strong. I mean, you know, the unemployment rate is still at historic lows, but we have sticky inflation and we're starting to see these cracks form underneath. So I think what it means is that in the near term anyways, the Fed's going to be very cautious and data dependent as they start to their easing cycle.
Yeah, and one sort of train of thought I'd heard is that, you know, maybe as far as the dual mandate is concerned, something's got to give, you know, if the prevailing bias is for a rate cut, and certainly before the end of the year. It's been a fantastic conversation, David. Thank you so much for joining us here at the Schwab Network. David Busch, Co-Chief Investment Officer at Trajan Wealth.